Right now, $2 trillion in loans are sitting inside a financial system that most people have never heard of. These loans were made with your bank's money. They were designed to avoid every regulation put in place after 2008. And this week, the cracks became impossible to ignore. On March 18th, PIMCO, one of the largest bond managers on Earth, issued a warning that reads like a pre-crisis memo. The president used the word reckoning. Their head of structured credit said the interconnection between traditional banks and non-bank lenders has reached a level that regulators never anticipated. And the numbers back him up. According to Federal Reserve data, bank loans to non-depository financial institutions, that's the polite term for shadow banks, have surged from $300 billion in 2015 to $1.9 trillion today. That's not a typo. That's a six-fold increase in less than a decade, and almost none of it shows up on your bank's balance sheet the way you'd expect. Here's what happened. After the 2008 crisis, regulators cracked down on banks. New rules, stricter lending standards, more oversight. Banks couldn't make the risky loans they used to make. So the risk didn't disappear, it migrated into something called private credit. These are funds run by firms like Blackstone, Apollo, and dozens of smaller players. They lend money to mid-market companies, businesses too small for public bond markets, but too big for a local bank. And for a decade, it worked beautifully. Returns were high, defaults were low, money poured in. The private credit market ballooned from $400 billion in 2015 to $2.1 trillion today. And the pitch to investors was simple. Stable returns, low volatility, no drama, but here's the part they left out. When private credit funds make these loans, where do you think the money actually comes from? A huge chunk of it comes from your bank. Banks provide leverage to these funds through something called subscription lines and warehouse facilities. Your bank lends money to a private credit fund. The fund lends it to a company. The company pays interest, and everyone pretends the risk stayed with the fund. Except it didn't. Because if that company defaults and the fund can't cover, the loss rolls right back to your bank. And right now, the defaults are accelerating. Fitch just reported that private credit default rates have surged to 9.2%, the highest on record. Compare that to high-yield public bonds, sitting at under 2%. The so-called safe alternative is defaulting at more than 4 times the rate of the asset class it was supposed to replace. And that's just the lending side. What happened this week is what should genuinely concern you. Blackstone's $82 billion flagship private credit fund just got hit with $6.5 billion in redemption requests, nearly 8% of the entire fund in a single quarter. Investors want out. Blackstone executives had to inject $400 million of their own capital just to stop the bleeding. And they're not the only ones. Another major fund saw withdrawal requests hit 9.3%, almost double its quarterly redemption cap. So what did the fund do? They locked the doors, redemptions capped, your money stuck inside. This is the liquidity mismatch that PIMCO has been warning about for months. These funds promise quarterly liquidity, meaning you could pull your money out every 3 months. But the underlying loans are 5-year commitments to mid-market companies. You cannot sell a 5-year loan to a struggling software company in 3 months, not at any reasonable price. So when too many investors head for the door at the same time, the fund has 2 options: sell assets at fire sale prices or gate the redemptions. And both options are catastrophic. Fire sales push down asset values across the entire private credit market, which triggers more redemptions, which triggers more fire sales. That's the doom loop. And gating redemptions destroys the one thing these funds were built on, the promise that your money was accessible whenever you needed it. Now here's where it connects to you, even if you've never invested in private credit in your life. Remember that $1.9 trillion in bank loans to shadow lenders? JPMorgan Chase just started marking down the value of loans tied to private credit funds. That means the bank is admitting, quietly, that these loans are worth less than what's on the books. When a bank marks down assets, its capital ratios shrink. When capital ratios shrink, the bank pulls back lending. Fewer mortgages approved, fewer business loans issued, tighter credit for everyone. And the Federal Reserve just told us they can't cut rates. Not now. Inflation is running at 2.7%. Tariffs are adding pressure. The war in the Middle East has oil prices on a knife's edge. The Fed is trapped. They can't lower rates to ease the pain, and they can't print money without making inflation worse. The playbook that saved Wall Street in 2008 and again in 2020, cheap money and emergency liquidity, is not available this time. 18 years ago this week, Bear Stearns collapsed. An 85-year-old bank erased in 72 hours. Its stock went from $170 a share to 14,000 employees lost their retirement savings overnight. That collapse started with exactly this pattern: hidden leverage, interconnected institutions, and a liquidity squeeze that turned into a full-blown panic. Back then, the shadow banking system was about $1.2 trillion. Today, it's nearly double that. Back then, the Fed could cut rates to zero and print $4 trillion to stop the bleeding. Today, rates are at 3.5% with inflation running hot, and the Fed just voted 11-1 to hold. The safety net that existed in 2008 does not exist in 2026. Here's the reality. The financial system didn't get safer after the last crisis. The risk just moved somewhere harder to see. $2 trillion in private credit, funded by your bank, underwritten with the same arrogance that caused the last collapse, and now cracking under the weight of rising defaults, AI-driven disruption, and a wave of panicking investors demanding their money back. You won't hear about this on the evening news until it's too late. You're hearing about it now. What you do with that information, where you keep your savings, how much liquidity you hold, whether you trust the institution holding your money to survive what's coming, that's on you. But at least now,